Can you give us a little bit of an insight on your macro perspective of what's going on in the economy right now?
Is that our narratives about the economy are not necessarily a good reflection for what's actually going on. And that dichotomy, the difference between our narratives and reality right now, have really reached a fever pitch.
Cap rates have kind of stabilized. What's your outlook on, just the future of commercial real estate values?
I still think the industry is being excessively optimistic about the future of capital costs. A lot of, shall we say, confidence in the fact that future interest rates will be lower than they are today. I don't think that's true. Reality will return to equity markets. Bubbles end. Excessive prices return to earth. What goes up must come down. Whatever is too good to be true is not true. When that happens, that money is no longer going to come into the United States. Suddenly, we will be self-funding our federal deficit, and that'll cause an increase in interest rates. It's just the craziness of policy. Because what we hear from Sacramento all the time is we want less industrial, but we want more light manufacturing.
If you read the mainstream financial headlines right now, the narrative surrounding the economy is incredibly grim. We are being told that the consumer is completely tapped out, a commercial real estate default wave is crashing over our banks, and the great industrial boom in the Inland Empire is officially over. But the objective data tells a completely opposite story. My guest today is Dr. Christopher Thornberg, founding partner of Beacon Economics and research fellow at Pepperdine School of Public Policy. His latest June 2026 outlook shows that while public perception is bleeding negative, American household net worth is actually at a record high, consumer spending on goods and package deliveries is holding steady, and domestic manufacturing construction is up a mind-blowing 75%. However, he's also tracking a massive hidden imbalance, a multi-trillion-dollar unfunded federal liability, and a dangerous reliance on foreign capital that could trigger a major fiscal crisis if ignored. Today, we cut through the noise to break down the true industrial real estate forecast, dissect the regulatory squeeze hitting California land, and separate the political friction from the economic reality. I'm Shy Assar, and welcome to Adding Value. Chris, thank you so much for coming this morning. It's a real pleasure to have you here. When we look at the overall economy in the last couple of years, we've had pretty sticky inflation, rising interest rates relative to 5 years ago, and sentiment across the board is mixed. Can you give us a little bit of an insight on your macro perspective of what's going on in the economy right now?
Well, let's be a little more specific about some of the timing you threw around there. Yes, interest rates are higher now than they were 5 years ago. There's no doubt about that. That said, actually, over the last couple of years, things have been reasonably steady, right? The 10 years been between 4 and 4.5%. Inflation actually has cooled off up until, of course, just the last couple of months with the oil hit. But even that, I think you're already seeing that start to fade away. Oil is strictly a transitory effect, and the June number came in relatively reasonable. So on that particular basis, really honestly, the last couple of years from an economic perspective have been fairly stable, unlike what the headlines would have you believe. Now, when I think about the economy, I probably should have started with this, but there's two ways of talking about the economy. One is looking at the data and seeing what's actually happening in the economy. But the other one is looking at the headlines and figure out what people are thinking about what's happening in the economy. What I've had to appreciate, particularly over the last decade, is that our narratives about the economy are not necessarily a good reflection for what's actually going on. And that dichotomy, the difference between our narratives and reality right now, have really reached a fever pitch. And I mean that really in two different directions. You started out by talking about mixed, if you will, metrics on confidence on the economy. Well, that was, I think you were very soft saying that. I mean, look where we are right now. I like to focus on two specific narratives about the economy. One is the University of Michigan consumer sentiment index, right? That's very clearly how do you feel about the economy. And right now, that's near a record low level. People are obviously, at least from a sentiment standpoint, pretty unhappy about where things are. The other narrative to pay attention to is the stock market.
Right.
And I appreciate that for anybody who took a finance class, you all learned that the value of a stock is a net present value of the infinite future profits of some particular share of a company, which, by the way, is completely unmeasurable. Ergo, the stock market is really a narrative. And of course, the stock market is at an all-time high level. It is true the corporate profits have come up a bit, but even accounting for that, we have the second highest PE ratio in the history of the stock market. So you have one major narrative telling us things have never been better, and you have another major narrative telling us that things have never been worse.
Right.
And in the middle of this, the actual economy is just trucking along at a 2.5% rate. So it's a very interesting world we live in at this particular point in time, because of, again, of all these odd divergent opinions about an economy that at its core is fundamentally, well, fine.
Why do you think that dichotomy exists then?
Well, I think you have to start with the basic idea that there has always been a gap between our narratives on the economy and what's actually going on. In fact, a few years ago, Robert Shiller, Nobel Prize winner, wrote a wonderful book called Narrative Economics, where he dove into this, and he dove into the power of narratives. And he went so far as to make a point that I very much taken into sort of how I think about the economy, is that this divergence between narratives and reality may well be the centerpiece of business cycles. I mean, you go back over time and you think about the tech business cycle at the start of the century, which was driven by the new economy narrative. And then you had the subprime nonsense, which led to the Great Recession, which was driven by this weird narrative that somehow or other real estate could appreciate by 10% per year forever, which obviously is not a realistic opinion of any asset market, particularly housing. And so when you look through history, more often than not, it's these big divergences that create the kind of imbalances in our economy that eventually break and cause the manifestation of what we call a recession. Now today, again, you have two different narratives pointing in two completely different directions. You have the excessive optimism of the stock market driven by the narratives around AI. But then when you think about that weak sentiment index, that is being driven in large part by the kind of nonstop populist rhetoric that's being fed to us really by both parties. I mean, it used to be that the Democrats were populists and the Republicans were realists. But in the last 15 years, the Republicans have become, if you will, they have even bigger set of populists than the Democrats. And when you have both parties constantly telling you that your life is terrible and it's all the other party's fault, well, it starts to get into your head. And I really believe that that's what's driving that sentiment index. I've said all that, and I forgot to point out one of the obvious things, which is as much as sentiment index is weak, it's not based on anything resembling reality. Per capita, real inflation-adjusted consumption in the U.S. right now is at an all-time high level. You've heard that there's some sort of K-shaped recovery where that number is driven all by the top 20% of Americans. That is a complete fabrication. The actual data tells us that really all households have seen an increase in their incomes over the last few years. And that being said, really this kind of prosperity is being enjoyed by nearly everybody in our economy. It's just that nobody's actually appreciating that.
Yeah. You know, one of the things that I've been tracking pretty closely, because to your point about the narrative of what's going on, has been kind of the war in the Middle East, and what the rising energy prices are going to do to our economy. And the narrative that has been spinning around a lot is that rising energy prices are going to lead to even substantially higher inflation. In addition to that, there's this kind of recycling of the petrodollar, the dollar that gets invested into AI through the Middle East, and if that spigot turns off, we could be facing an economic catastrophe. I mean, these are the words that are being thrown around.
Right. And again, that's exactly the type of apocalyptic speech that is completely nonsensical. Look, let's just start with the basic idea of U.S. oil dependence, which stems from what happened back in the 1970s when we had the OPEC embargo. It wasn't handled very well from a policy standpoint here inside the U.S. And yes, we ended up with gas lines and so on and so forth. This is not that world. Let me give you one basic metric on this. If you go from 1970 to today, the U.S. economy has grown roughly by a factor of 4. Believe it or not, our economy today in 2026 is 4 times larger than it was in 1973. Okay, our consumption of oil in real just barrels of oil perspective over that same time period, our increase in the consumption of oil has gone up by 15%.
Wow.
So we have a 400% increase in the size of the economy, a 15% increase in the consumption of petroleum. We're not a petroleum-based economy anymore. It is a product that certainly plays a role in certain industries, but for the most part is just not as central to what we do in our nation as it used to be. And it's funny that we can't seem to walk away from this idea. And of course, you can even add to that, because back when we had that oil shock in the 1970s, remember, we were a big oil importer, particularly from the Middle East. Today, the United States is an oil exporter. Because we've seen an enormous amount of production capacity inside the United States because of all the new technologies wrapped around oil. So in a very real sense, if you look at it, you could almost argue that this is great for the U.S. economy. It might actually get the oil industry up and drilling again, because they haven't been for the last couple of years. The reality is at $60 a barrel, it is not worth putting more straws in the ground. The petroleum industry has just been kind of sitting there idle because of this global oil glut that we've been in the midst of. So this could be their opportunity.
Tying this all, obviously, I work on the industrial side, and the last 5 years, it feels like our market on the building sales side, we were in a bit of a discovery, right? Prices were declining, lease rates were declining, interest rates were volatile. Not volatile, but like there was a lot of uncertainty, but it feels like the capital markets have stabilized as well, where you have an understanding of where interest rates are going to be. And as a result of it, cap rates have kind of stabilized.
Sure.
What's your outlook on, just the future of commercial real estate values?
That's a big question. And I agree with what you said, with one modest, what I would call, alteration.
Sure.
You said there's an agreement as to what's going to happen, agreement about the understanding of what's going to happen. There isn't really an understanding about what's going to happen, but there is an agreement. And the agreement is that the industry believes that interest rates have pretty much peaked, and eventually they'll start settling back down again towards maybe something we were at. I won't say in 2021, because those were abnormally low interest rates, but maybe something that we saw, say, in 2019, for example. I don't necessarily agree with that particular assessment. So that is to say that while I do believe the industry has stabilized, cap rates have stabilized, I still think the industry is being excessively optimistic about the future of capital costs. Now,
you mean they're baking in essentially discounts in their pricing,
right?
So because they think interest rates are going to go down,
right? If you look at let me be blunt. If you look at cap rate spreads right now, they're pretty tight. The cap rates that properties are selling and buying for are not that far above where the 10-year bond is right now, and that to me suggests that there's a lot of shall we say, confidence in the fact that future interest rates will be lower than they are today. I don't think that's true. And why I think that boils down to two things. One is where the federal budget deficit is going. And two, why the enormous increase in the deficit hasn't already caused an increase in interest rates. So let's start with part one, the federal budget deficit. Look, I've noted that the U.S. economy is fairly stable. We're growing at a fairly decent pace right now. And we're doing so because household finances look really strong. Again, per capita income, disposable income at an all-time high level. Obviously, wealth levels are high because equity markets are so frothy, which is all well and good. But when you think a little bit harder, say, about that record high disposable income, you immediately start to see a problem. Because one of the reasons that disposable income is so high right now is because we're not being asked to pay for all the wonderful spending of our federal government. And federal government spending has been increased a lot over the last decade. There's obviously been enormous increases in spending on the entitlement programs. There's been an increase in spending, particularly on defense. And the net result of this is that this year we were highly likely to see something on a basis of maybe a $2.4, $2.5 trillion federal deficit. It was supposed to be smaller, but of course, when the Supreme Court shot down the tariffs, well, a big part of the revenue basis for the one big beautiful bill went away.
Right.
And
Makes
we're
sense.
left with much larger deficits. In fact, the deficit we're seeing right now is going to be close to 7% of GDP, which means this will be the largest federal deficit we've ever seen in a full employment economy. That's not sustainable. It's just not. We cannot, as a nation, continue to borrow at this much of a pace. And when you go to the household and you start to think about what that means for an American household, well, more or less, it boils down to about a $6,000 to $7,000 subsidy for every person living in this nation. That is how much you don't have to pay in taxes
as a result
because of the
increase.
current pace of borrowing.
Yeah.
So at some point in time, we're going to have to shrink that deficit. And that means raising taxes, cutting spending, and suddenly there's not going to be much disposable income. Now, that's obviously going to have an economic impact because people are going to have to pull back on spending. But even more so, what worries me in a much larger scale is what the political ramifications of that change will be. Because we already mentioned, sentiment is at an all-time low level. Sentiment's at an all-time low level, despite the fact that spending is at an all-time high level. How are people going to feel when they're suddenly told, hey, guess what? You don't even deserve this. You should be consuming less. You need to be saving more. You need to pay more in taxes because we got to pay for defense. We got to pay for Social Security. We got to pay for roads. Well, the political ramifications of that could be very ugly. We just don't know. We have to wait to the point in time when we're forced to acknowledge this problem. Now, the second part of this is, why hasn't this already caused an increase in interest rates? Look, put all the other stuff to the side. In the end, interest rates are driven by the supply and demand for capital. There's an increase in demand for capital because of a big government borrowing binge. That should be putting interest rates up.
Yep.
Unless there's been a big increase in the supply of capital, which is offsetting, if you will, the increase in demand. Well, okay, well, where's that coming from? Where's this supply of capital coming from? And the answer is the rest of the world. Over the last couple of years, in large part because of our excessive returns, our equity market returns we've seen in this nation, driven in terms by the AI bubble, the rest of the world has been pouring trillions of dollars of investment into the United States. They think they're getting involved in venture capital funds. They think they're buying AI equities. What they're really doing is covering the federal deficit for us. And that, of course, is how you can try to see this thing coming to an end. And then some point in time, reality will return to equity markets. Bubbles end. Excessive prices return to earth. what goes up must come down. Whatever is too good to be true is not true.
Mm-hmm.
When that happens, that money is no longer going to come into the United States. Suddenly, we will be self-funding our federal deficit, and that'll cause an increase in interest rates. At the same time, it's going to cause a depreciation of the dollar, which is going to be a little bit inflationary because it'll make imports more expensive. So the combination of those two, interest rates drifting up and inflation drifting up, completely ties the Fed's hands. And of course, inevitably starts pushing us down the path of some sort of fiscal reaction, response. I don't want to say crisis just yet. Perhaps we'll deal with it appropriately when it happens. Probably not. But we're going to have to wait and see. What I'm talking about is something that's going to happen in the next few years. But anticipating when that's going to happen is nearly impossible. Because it all, of course, stems from the ending of this particular stock market bubble. And we don't seem to be at that point yet.
You bring up an interesting point, because one of the questions I definitely wanted to ask you, which kind of ties into what we're talking about, is there's this kind of general narrative, right? In our market, we just finished doing a second quarter market report, and it feels like from industry professionals in our space that the floor is in. It's we're bottoming out. And we may be, there's some talk amongst the institutions that this time next year we may be seeing rent growth again. And there's been a lot of the thought, or if only the Fed were to reduce the interest rates a little bit,
right,
then businesses would get back to borrowing at a lower cost of capital, stimulating growth. Cap rates will start to compress, values will go up, and we're back to the glory days.
Right.
But it sounds like, based on what you're saying, that that we might have rent growth 12 months from now, but has nothing to do with the interest rates.
So let me boil down what your question just a little bit. Are you asking me, is the real estate industry being excessively optimistic? And my answer is, has it ever not been excessively optimistic? This is the nature of the industry.
It's true.
Now, let's break it down just a little bit. Look, there's two sides to the industrial market. One is the front end of the house, the supply and demand for industrial real estate. The other is the back end of the house, which is the financing, the demand, the investor demand for this particular asset type. The front end of the house actually is fine. There has not been a decline in occupancy in industrial real estate. I mean, it's shifted around a bit. It's down a little bit in LA, but in the Inland Empire, it's actually hanging in there. It hasn't ever dropped. The problem has been, of course, we had that big surge in demand in 2021, 2022, and the industry, because it's excessively responded by violently overbuilding. So that new product coming online is starting to slow down. And as a result of that, because there's continued increases in occupancy, vacancy rates have started to stabilize. And in theory, yes, in a couple of years, as occupancy continues to go up, because it turns out industrial real estate is still in demand. It's a very important part of our economy. It contains, sure, logistics, but it also has wholesale, it has retail, it has professional, it has construction, and most of all, it has manufacturing. Because there's plenty of demand for this, demand will continue to grow, it'll continue to occupy space, and we will get through the supply glut. That's a completely different conversation than the back end of the house, which is, how do you value these things? That is a function, yes, of what happens in the front of the house, and I believe that you're right, we're past the bottom. But at the same time, there's also this anticipation of lower interest rates, which again is not in the cards. Now, you could say, hey, listen, can't the Fed just cut interest rates and everything will be great? But remember that the Fed doesn't control interest rates. They do control the federal funds rate, and the federal funds rate, because it's an overnight interbank lending rate, has some impact on short-run interest rates. But short-run interest rates don't really drive the overall market. Long-run interest rates do. And the only way they could really start to bring down long-run interest rates would be to start printing money again through quantitative easing, the way they did back in 2021 and 2020. The problem with that is that inevitably leads to inflation.
Sure.
And the one thing that really makes people angry is inflation.
Yep.
So there isn't really this possibility of the Fed just walking in and cutting interest rates and everything will be great, because that necessarily brings back inflation.
A quick note for our listeners. If you're an owner, asset manager, or leasing manager with a 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Shy Assar with Voight Real Estate Services, and let's add value to your portfolio. You know what I find interesting in our market right now? Pricing has corrected, and in some cases,
Stabilized.
Stabilized is the right word. So, in some cases, a lot of the buildings, as a result of what you mentioned about the front end and where lease rates are at and how you value the real estate, some real estate is worth less than replacement cost or dangerously close to it. In a scenario in which where you said that, you know, this potential, what did you call it? Was it a correction or a recession were to come on, and the asset bubble may burst? How does that trickle down into what we have at least perceived to be stabilized pricing?
Right. Well, from my perspective, the short-run cyclical effect of a recession is something that will have a short-run impact on prices. But the thing about recessions is they go away. So even if there is a recession, we know there's another side of it. To me, it still boils down to the idea that interest rates are almost assuredly going to rise, not fall, in the United States. I still go back to this idea that the real optimism seems to be about this idea that rates are going to go back to what they were, say, in 2019. And I just don't see that in the cards. Look, commercial real estate in general, like many parts of the economy, benefited a lot from this enormous long-run decline in real interest rates the U.S. economy went through over the course of the last 20, 30 years. That said, that seems to be really behind us. I mean, look, real interest rates were basically zero in 2021, 2022. They aren't going to go back there. Even now, they're running about 2%, which is low from a long-run standpoint. But when you recognize that we live in an era where there's more and more retirees, more and more demands on federal budgets, more and more demands for federal borrowing, to me, interest rates pretty much bottomed out. And from here on out, almost assuredly, they're going to be drifting up again. And of course, if we do have some sort of inflation, let's imagine we had another big shock to the economy, and yet again, the Federal Reserve runs to the rescue and prints a bunch of money, quantitative easing, causes another surge in inflation. Well, there yet again, you're going to see long-run interest rates start to rise, because that inflation risk premium is also going to start getting put back into that interest rate. So I think that everybody really, if you really want to have a long-run stable portfolio of real estate assets, I really think that people have to internalize the idea that interest rates are going to be higher in the future, not lower. But real estate is an optimistic industry.
Sure. And
people are looking at it that way. So it's something that I think that, well, the other side of it, we'll see when if these worries I'm thinking about actually arise.
So I'm going a little bit of a tangent here.
Yeah.
This is a little bit of a personal question. Pivoting to, on the topic of interest rates likely staying stable or rising in the future, how is this going to impact our generation, being guys who are maybe in their 40s or younger, looking to buy a home? Either they're upgrading their home, or buying their first home, it feels like there's some affordability crisis here in that regard. I mean, if interest rates, no?
Sorry. Yet again, I hate to keep bursting cherished bubbles. And Lord knows that millennials and Gen Y really cling to this idea that somehow or other it used to be that buying a house was really easy and cheap and anybody could do it. When in fact, no, not really.
Are you saying historically it's always been a challenging feat to be a homeowner?
I would, okay. The argument really boils down to what happened from 2019 to today.
Sure.
And the story is, in 2019, affordability was normal, and today it's way above normal. The reality is, affordability was record good in 2019,
mm-hmm.
and it's gone back to normal over the last few years.
Mm-hmm.
The reason affordability was so good, really, for that decade after the Great Recession, was because there was a whole generation that was so scarred by the mess they saw that they viewed residential real estate as some sort of tainted asset.
Mm-hmm.
And everybody stayed away from it. And look, they were told to do that. They were told by Mark Zandi, Mr. Zandi, who's constantly in the news telling us how terrible and tragic everything is. He was out there in 2019 predicting a recession driven by overvalued real estate. But again, when you looked at real estate, you looked at interest rates, you looked at income, never had affordability been better than it was in 2019.
Mm-hmm.
Simple as that. Now, you flash forward to today. What happened? Well, over the course of the pandemic, interest rates went up. We've already talked about that. But there was also this recognition that I do want to own a home. I know it looks like prices can go up. And wow, I want to get in. And what happened, of course, is not only did that decade bring us record affordability, but the lack of interest in real estate meant we had very little supply coming on board.
Mm-hmm.
Really, from 2009 to 2019, the pace of home building in this nation was incredibly low. It was incredibly weak. Well, when suddenly demand heated up and everybody wanted to get in again, we ran up very quickly up against that supply problem. And that lack of supply is what's caused, I think, a little bit of the current issues in real estate. I mean, there's no doubt if you look at the market, if you don't own a home right now, it's a big jump to get in there. But that's a supply problem. It's certainly not an affordability problem, at least in the way I think of affordability. And I know it sounds confusing, but let me explain. There's a story, constantly hear the story about how we have an affordability crisis in the U.S. And what they will do is they will look at, say, the median price of a house, they'll control for interest rates and say, this is the monthly payment and this is what the median income is. As if somehow or other that median income household is trying to buy that house.
Mm-hmm.
No, they're not. That's a really bizarre way of thinking about affordability. The true metric of affordability is to look at what people are actually paying for their homes right now. And by the way, homeowners in the United States, right now, they're paying a record low share of their income for housing. It's never been lower. And a big part of that is because a lot of folks back in 2021 refinanced at 3%.
Yeah, that's what I was going to say.
Yeah.
That's probably
And so they're sitting on incredibly low payments. They've seen a huge increase in their equity. You know, equity in American residential real estate right now has never been higher. The average equity in the United States is over $400,000. That's average. You have a record number of households that don't have any mortgage at all. And then, of course, for those that do have a mortgage, again, many, like 70% of mortgages out there are 5% or lower. So for people who own homes right now, they're fine. They're absolutely fine. There is absolutely no affordability problem, but they're not going to move because they have that low interest rates. And so for someone on the outside of the market who wants to get into the market, well, the kind of entry-level homes that would typically be available are not available.
Right.
Because those people aren't moving. So you do see this kind of stickiness in the market. But that stickiness ultimately is a function of a lack of liquidity because of the crazy movements in mortgage rates driven by crazy Fed policy and the overall lack of supply in our economy.
Got it.
But again, we don't have an affordability crisis. There is no crisis.
So, Chris, you recently did a big report for NIOP on the industrial market in Southern California.
Yeah, that's correct.
Can you tell us a little bit about that report?
Right. Well, if you look around what's been happening in terms of industrial and the narratives around industrial from a political standpoint, what you see here in California has been this big pushback. Mm-hmm. It's interesting because typically I think industrial has pretty much been under the radar, right? It's the kind of industry that people don't think much about. But with the delivery culture coming online, with so much investment in logistics, particularly here in Southern California, it suddenly became the focus of attention.
Sure.
Both from an environmental standpoint because of quote unquote pollution and traffic, and then from this kind of zoning standpoint where, oh, we don't want these big ugly buildings in our backyard. So you've suddenly seen this big political pushback. Prop 98 at the state level, planning boards across the region are just regularly shooting down new industrial projects. Cities are outright banning new industrial projects. And I was, I think, well, for me, again, thinking about narratives versus reality, what we're seeing in terms of this reaction is very dangerous. Mm-hmm. Because before you start to just regulate industrial, do you understand what the costs are of putting these constraints on this particular industry? So what my company Beacon did was we partnered up with NIOP Southern California and with Pepperdine University to put together a really a 3-part report on the impact of industrial real estate here in the 4-county region. We just released the first one, very great report. I thought my folks did a great job on it. But to give you a sense of it, what we did was really something very unique. We were able to match company by company employment data with property by property industrial data.
That's incredible.
Very unique, right? We have some access through some of our development partners to this confidential employment data. Using this, we were able to go on a property by property basis, figure out who's in there and what kind of operation are they running. Because again, go back to this political story. The political story is every industrial warehouse is just a huge box that has a few lousy jobs who are busy transshipping junk from China to kids in the Midwest.
Yep.
That's not at all what industrial is. And it is to say that's not part of it. I mean, you can look out in the Inland Empire in particular, and there are these enormous logistics centers. Think about, for example, the World Logistics Center out in Moreno Valley, which has, of course, the big Skechers facility, which, by the way, is way more than transshipping. I mean, they take millions of shoes and they box them and label them and do all that stuff before they ship them out to the rest of the United States. But this is the kind of operation that we are kind of trying to regulate out of the economy with all these rules and planning boards and all this kind of thing. So we did this big report, we matched the stuff up, and what we found was that the industrial ecosystem is incredibly broad-based. Mm-hmm. Most of the jobs, yes, are in traditional logistics, but the second greatest number of jobs in industrial is manufacturing.
Right.
And that's, for me, this gets to what I think is just the craziness of policy. Because what we hear from Sacramento all the time is we want less industrial, but we want more light manufacturing, without anybody recognizing that, hey, by the way, light manufacturing operates in industrial. Mm-hmm. You can't have both of these things. Mm-hmm. But then, of course, it didn't just stop there. It's wholesale. Every time you sit down in a restaurant in Southern California and you start eating food, that food came from a wholesale facility in an industrial warehouse somewhere in your neck of the woods. Construction was in there. Professional services was in there. R&D was in there. The movie industry was in there.
It's a huge ecosystem.
It's a huge ecosystem. Yep. And when you add it all up, we recognize that there are close to 1.5 million jobs. You're talking a huge number of jobs that are inside these warehouses and the supply chains they generate. Our numbers suggest that industrial real estate is more or less, it contains about 11% of all economic activity in the 4-county region. So when you start to recognize that this is not just something that you can get rid of lightly, you start to recognize the danger of this pushback. Mm-hmm. I like to think of industrials almost as it's kind of the skeleton of our economy. Mm-hmm. It's in the background. It's holding everything else up. It may not be the muscles, it may not be the eyes, but it's holding everything else together. And we have to appreciate the importance of that skeletal structure when we start making these policies.
100%.
Yeah.
Just to kind of build on what you're sharing, Chris, is as you mentioned, there are several municipalities, especially, for example, when I look at the Inland Empire, in the western, the more infill areas, and even in the east, where there, as you mentioned, zonings are being changed, moratoriums are being put in place, and it is forcing requirements and developers to start exploring, developments in, I don't want to call them tertiary, but further markets, right? Yeah. The high desert. What is going to be the overall impact to those markets as a result of losing that industrial product?
Again, so the thought process is by regulating these away, we're going to create less traffic. But if you just push them out to the hinterlands, you're going to create more traffic. Mm-hmm. You're going to have longer commutes. You're going to have more, in the end, pollution driven by all these people driving around. You don't want these things in the hinterlands. You want them close in. You want them close to workers. You want them close to the businesses that rely on these warehouses. This is not, again, a helpful way to approach things. Now, I'm not saying we should be dropping industrial warehouses in the middle of every single-family neighborhood.
Sure.
But clearly, we have the ability and capacity to have zoned areas where industrial operates, and then close by, you can have residential real estate. They can coexist side by side without any kind of problem, and both sides benefit. The houses have close by jobs, and of course, they also are able to get better, if you will, local services.
Sure.
The food at the restaurant's going to be fresher because it got delivered today, as opposed to 3 days ago from some warehouse out in Blythe or something like that, right? So it becomes kind of a win-win proposition. I don't have a problem with land use planning. What I do have a problem with is knee-jerk policy that is delivered on the basis of simplistic narratives rather than complete economic analysis.
And so if you're talking to somebody in our space, right, and inherently our business, as you mentioned, is an optimistic business.
Yeah.
But for those guys who are out there who are thinking about how to approach the business, whether they're an investor, whether they're a developer, whether they're a broker, and they're working with businesses and kind of planning their future in industrial real estate, what is kind of your words of advice, kind of economic, I don't know, forecast, but kind of forward-seeing outlook they should have?
Right. Well, I go back to the idea that the world is driven by narratives. And I think that the industry has been too complacent. They have always been kind of below the radar. They didn't have to worry about it. They kind of did their thing and things were fine. But now that world is gone. And as a result of that, if you want your industry to continue to thrive, well, then you have to lean in. You have to become part of fixing these narratives. Again, our work with NAIOP Southern SoCal, and yes, NAIOP IE was part of this as well, was a first step in that process, right? It gives, because we've just done one paper, we have two more coming. We have one that's going to talk about what we call upstream effects, another one's going to be fiscal effects. And all of these are stories that people in the industry can use. When you're at that planning board, this is the real story. When you're talking to people in the neighborhood, this is the real story. You have to take charge of that. You have to push back, because if you're not controlling the narrative, somebody else is. And that means you are no better than sitting on a raft in the ocean without a rudder or a tiller, right? You don't know. You're at mercy of the weather. But if you take control of the narrative, right? Do the impact study, do the employment study, do that analysis, get the word out. If you're in front of that, if you're in charge of that, well, then you can make your world better, even as you're making the overall economy better. But that takes commitment. It means being involved. It means doing this.
Yeah.
And I think that you need to see more of this.
It sounds like, and you summed it up really nicely, that regardless of where you are in the value chain in industrial real estate, if you want to lean in on having a successful career, you should take a proactive responsibility in an advocacy role.
Absolutely.
In protecting the industry.
Yeah. And in the end, if you're a broker, you want to be an advocate for your clients, right? Because your role is now greater than just being a broker, just being the information guy telling them, oh, it's worth this much, it costs this much, it has these kind of renters. Now you're an advocate for the industry. You help the industry, you help your clients, and by the way, by doing all that, you help yourself.
100%. And you earn the client.
And you
earn
the client. 100%. Exactly right. Yeah.
Well, I've really enjoyed this conversation, Chris. Thank you so much for coming in today. And we look forward to always hearing you speak at the Economic Forecast. So appreciate your relationship.
Great to be here, and nice talking to you.
Thank you, Chris. Thank you for listening to Adding Value with Shy Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.